trying to help you guys out. I should be selling whole life insurance. Also, the cash value that you're accumulating doesn't grow at the 8% like it would if you invested it yourself. It does grow some. It'll be about half that, maybe 4%. This 4% you're getting doesn't really start happening until many, many years, maybe 10 or 15 years into paying your policy.
That's not true. That is not true. Again, it's a half truth, okay? Because the longer you have the whole life policy, the more efficient it becomes, and eventually it gets to the point where it's made 4%. It's a little. I want to make sure I explain this correctly. So, for example, my whole life policy. One of them, both of them, they make right around 4% for the life of the policy. Right now, they're not doing that. I'm actually still catching up to my, I still need to reach my break-even point because I've only had the policies for like almost 3 years now. So there is a break-even point, and it takes a little while for the whole life policy to reach that 4%. But here's the important distinction. When it reaches that point, that doesn't mean that now it's making or earning 4%. It's as if it was earning 4% the entire time of the policy, the entire life of the policy. It takes time to get more efficient and to reach that point. But once it does, it's as if it was earning 4% the entire time. All right. That's a very important distinction. Now, again, I just want to reiterate here. He's talking about, oh, you could get 8% over here, only 4% in a whole life policy. Well, then why do you own bonds? Why do you have a savings account? If why ever save money if you're only ever going to earn 3 or 4% in a savings account? That sounds like a bad investment when you can earn 8% over here, except that would be a ridiculous argument. You never want to, usually anyways, you ask most advisors, you never want to have all of your money in the stock market earning that 8 to 10%. You want to have some bonds or some safer assets to balance out that volatility, usually. Okay, so why is it only whole life insurance that is awful just because it gets 4%? Not to mention the tax advantages you get as well. You could earn 8% over here in the market, all right, but you're going to have to pay taxes on that. I'm earning 4% over here in my whole life policy. That doesn't include the tax advantages. Like, what would I have to make in a pre-tax or a taxable account to equal the same internal rate of return that I could have with those tax advantages in a whole life policy? I'm not trying to compare whole life and investment. That's just kind of where that's his argument right now. Out here, internet has just been ridiculous. Sorry about that, guys. Anyways, I'm just trying to make sure that you guys understand or hear the other side of the story where we get all of these other benefits. We're not trying to compare them to investments, just like you wouldn't say that, oh, bonds are terrible, I only get 4%, so I'm going to put that money into the market. No. We balance things out here, right? We balance out that volatility with safe assets. So for me, a safe asset that gets 4% internal rate of return plus tax advantages, plus I'm gonna have that death benefit and all that. That sounds pretty good to me. And I can use the cash value to build wealth like I normally would. Sounds pretty good to me.
Policy is actually negative for a long time because of all the commissions and various other fees. In fact, here's one of the biggest scams involving whole life: the damn fees. It's actually kind of impossible to get a clear picture of what the fees and commissions and payout actually are for a whole life insurance policy. I challenge you to find an example of a whole life insurance illustration that clearly details the costs, similar to a way a mutual fund has to tell you the expense ratio, sales commission, other fees. They're just not transparent, probably by design, which makes it impossible to understand what you're truly paying for and what you're actually getting. Remember the cash value I was talking about?
Yeah, so here's the thing about that, because he's right. You don't get an expense breakdown with a whole life policy. It's just one of the reasons for that is because everything is level. There are lots of guarantees in a whole life policy. Your cost of insurance and stuff like that. It's everything's level throughout the policy. So the thing is like on the illustration, if you don't like what you see, then just don't buy it. Okay. But expect to get roughly 3.5% to 5% net internal rate of return, depending on the factors that I mentioned earlier. If you don't like it, then just don't buy the product. Okay. In my opinion, I don't need to see a full detailed breakdown of that. And, he's talking about mutual funds, how they have to break down all their fees. I would argue that they're actually not very good at doing that. And also a lot of times they break it down because those things can fluctuate, right? So you need to know what those expenses are. With a whole life policy, everything is level. The only thing that's not guaranteed with a whole life policy is the dividend. That's pretty much it, but they've always paid a dividend. Right. Another example would be like index universal life policies. That it's an argument that agents make against whole life and in support of IUL. They say, oh, it's more transparent because you can see all the expenses and stuff. Okay, that's fine. But that's because everything can be changed in an index universal life insurance policy, or a lot of things can at the expense of the policyholder a lot of times in order for the the life insurance company to manage its risk, right? But just because I see it, that doesn't mean that all of a sudden that, like, to me, that's not a deal breaker. Like if you don't like what you see on the whole life illustration, then just don't buy it, and make sure you're managing expectations about what this product is and what it's doing. It doesn't mean it's a scam. Like if I go to Best Buy and I buy this TV or whatnot, all right, do I need a full expense breakdown on everything that it cost to put that TV together? And if the person that's helping me with it, are they going to get a commission or whatnot? I don't really care. I want the TV. Now, I'm not saying that we shouldn't be aware of certain expenses in certain situations, okay? But with whole life insurance, because those expenses are level, it's just like this is what you see is what you get here, other than the dividends. That's it. So anyway, that's my 2 cents on the lack of transparency argument.
Well, maybe getting the death benefit and the cash value payout at the end could add up to something serious, right?
Oh,
No,
gosh.
that's not what happens. The cash value that you keep hearing about disappears into the insurance company's pockets when you die, and your family only gets the death benefit. If you have an outstanding loan at this point, it'll just get subtracted from your death benefit. But wait, the whole life insurance salesman wants to remind you, you can still borrow against your whole life insurance policy's cash value. You can.
Okay. Oh man, this is a very bizarre argument. I don't really know where this comes from. I like why people expect to get the cash value and the death benefit. Let me ask you something really real quick, guys. If you if you own a home that's worth $300,000 and you have $150,000 of equity, all right, which means you still have $150,000 on the mortgage, right? Let's say you sell that house tomorrow for $300,000. Would you really expect to get $300,000 and your $150,000 of equity for a total of $450,000? Of course not. That would be ridiculous. The banks would think you're high if you demanded that and if you complained about it, right? Well, how is that any different with whole life insurance? Like, again, the cash value is the equity in the contract. It's what you can borrow against if you need it. The death benefit, you could compare, like using the home analogy, you could compare to the value of the home. The death benefit is the value of the life insurance contract. Okay. So why would we expect to get both? Like, you don't expect to get both when you sell your home and you still have a mortgage on it. And here's the other way that I explain it. This isn't technically what happens. All right. I want to be very clear on that first. This is not technically what happens, but this is just another way of thinking about what happens to the cash value and how it supports the death benefit. Okay, so let's say I have $1 million death benefit and I have $500,000 in cash value, and then I pass away. Okay, according to this guy, the life insurance company steals your cash value. They don't. Okay, you can make an argument that your beneficiaries actually get the cash value plus more. Okay, so let's run this scenario. I pass away, $1 million death benefit, $500,000 cash value. Life insurance company is going to look at that contract and say, okay, we're going to give the $500,000 of cash value to the beneficiaries, and then we're going to add an additional $500,000 on top of that in order to meet our death benefit obligation. So there's an argument to be made that they get the cash value plus way more to equal the death benefit. Now, I want to be clear again and reiterate, that is not what actually happens. The life insurance company just writes the check, okay? And they get it income tax free. It avoids probate, all right? We're the ones complicating this for whatever reason and coming up with these ridiculous claims. But it's just another way of thinking about how and understanding how the cash value supports the death benefit, and how you could argue that it's part of the death benefit, right? But this idea that the life insurance company steals your cash value is just ridiculous.
Be your own bank. Isn't that awesome? Don't you want to stick it to the evil banks? Stick it to the man? I don't need you. I don't know. I think I'd rather have several $1 million in my bank accounts that I control and I have access to, and I'll just go to the bank if and when I need a loan. I'll be getting the best rates because I have a massive net worth. Banks will be beating down my door and buying me steak dinners. And this loan that you're supposedly taking from yourself, it isn't interest free. You're paying an interest rate to the insurance company for the privilege of borrowing your own money. That's kind of effed up. Look, if you
So no. Okay. Again, you're not borrowing your own money. You're borrowing the life insurance company's money. So there is an interest cost. Okay. But your money continues to compound. And I've done videos on this, guys, where like keeping money in the bank. I mean, you could do that. I keep some money in the bank, but I have most of my money deployed somewhere, a lot of it in my whole life policies. And then I borrow against it when I need it for wealth building opportunities, et cetera. We get so many more benefits from storing capital in whole life policies than the bank. And he's talking about, like not paying interest. Okay, well, here's the thing. We basically finance every decision that we make. We're either giving interest to somebody else or we're losing out on interest that we could be earning elsewhere. All right, it's called opportunity cost. So when you have money in the bank, granted, okay, and you could just use that money. Granted, you're not paying an interest. You're not paying interest cost, but now that money's gone and can no longer earn interest for you ever again. Okay. And I've done videos showing you guys, I've run the numbers on this. You could pay an 8% interest rate on a policy loan and only earn 4% in the policy. And over 5 years, you've actually made more than you've paid. I ran this example because I used my policy for the vehicle that I purchased a few years ago. And I used my policies to do that. But I showed you the difference between simple interest, paying simple interest, and earning compound interest. Okay, again, I have a little bit of interest costs. So what? It's absolutely worth it to continue earning that compound interest in the policy. Plus, I'm making money in whatever wealth building opportunity I'm taking advantage of. I'm building wealth in multiple places here. That little bit of simple interest is more than worth the cost. And then you could ask yourself, what benefits are you getting from having money in a bank? Think about that. You're actually okay. Again, you're not paying interest, but your purchasing power is being diminished every single year by 6 to 8% monetary, based on the monetary debasement rate of monetary debasement. Okay, you don't get any benefit from having money in a bank other than instant liquidity. And with a whole life policy, when I borrow against my cash value, I get it in 1 to 2 business days. Okay. But I get so many more benefits. I get the uninterrupted tax-free compound growth. I have access to the cash value if I need to. I get the death benefit. I could pay off the whole life policy. I have the chronic critical terminal illness riders. Do you get any of that with a bank account, guys? No. Now, I'm not saying not to have some money in the bank, but think about where you're storing capital and what is that doing for you? Are you actually getting any benefit from that? So